Welcome everyone. Welcome to this episode of Budget Ki Baat. I have with me Mr. Rahul Singh from Tata Mutual Fund, and this is going to be once again a very enlightening episode, wherein we'll discuss all there is to talk about the budgets and its impact on the markets. Sir, I'll get right to the meat of it. There are two stories playing around in the market right now. One is the capex side, the other is the consumer side of the story. Let's start with the capex one. How happy are you with the capex that has been announced, that is of 10.18 lakh crores? How happy are you with this number? And do you think this is substantive enough for growth of India?
Yeah, actually, the capex which the government had put in the budget estimates for this fiscal, about 11 lakh crores, obviously they were running short of that. And that is one of the reasons why the fiscal deficit is also lower compared to 4.9%. Because of the elections and various other factors, I think the government spending has been running below what they had budgeted. And that also brings me to the point that there is a limit to how much government can spend in terms of the physical capacity, and that is what they are kind of realizing, and is the same reason why next year's budget is only 8% growth from here, so about 11 lakh crores. But I think the important point to understand is that the union budget or the government budget is a small part of the overall capex which happens in the country, because a lot of capex happens at the state government level, a lot of capex happens from the PSUs, a lot of capex happens from listed companies, unlisted companies, and so on. And therefore, what you see is therefore a small fraction of the overall capex which happens in the country. And let me give you more anecdotal evidence on that. That if you look at the capex driven companies in the last 9 months, even though the government capex was, say, 10, 15, 20% below their budget, that has not stopped the companies from increasing their order book. If you look at the order books of the large construction companies also in the country, and the large capital good companies, everyone's order books have grown 20, 30%. So that would not have been possible if government was the only capex which was happening. So government capex or the central government capex is not the only capex happening, because if that was the case, in the last 9 months, the order books should have declined, but that is not happened. So that should give you further evidence that of what I'm saying, that when we look at government budget, it's a fraction of what the overall capex happening. So in my view, today the capex is picking up. It is not picking up like it picked up in the 2006 to 8 cycle, but it is picking up. If you look at the capex happening today in manufacturing, in energy transition, in a lot of sectors like cement, chemicals, paints, and every company we meet today is talking about capacity expansion over the next 1 or 2 years. So clearly there is capex happening on the ground level. Yes, government is running to an extent, it is hitting a limit as to how much the government can spend. But if you look at the overall capex kind of scenario in India, it is much better than what it was 3, 4 years back, and we don't see any slowdown in that. Actually, if you talk to the companies at the ground level, we don't see any slowdown. Whether that is enough or not is a million-dollar question, and obviously we could do with more. And I think what was probably lacking in the budget was the fact that although government mentioned that there will be new public-private partnership policy, we need to see how quickly that comes, and whether that public-private partnership policy is revolutionary enough or is dramatic enough for public sector or for private sector to start investing and complementing government's capex in infrastructure, because that really is the key. Whether we can grow capex even more than what is happening today, and that will be key to having more than 7% GDP growth rate. But overall, I think the message I want to give you is that the government budget is not the only driver of capex. There are other drivers which are intact, which have been intact in the last 9 months and which continue to be intact. And next year, with no, let's say, pause because of elections or no loss of time, I think government should also meet its budget. which I think is also a healthy, 11 lakh crores, 8-10% growth is not a small amount at that pace.
Absolutely, sir. Sir, you mentioned the fiscal numbers. Do you think this is prudent enough, and will it ease off the pressure for RBI at least a little bit so that they can tweak the interest rates in favor of growth?
Yeah, completely. I think we are the only country which has been reducing its fiscal deficit in a very systematic fashion, and we have been overachieving those projections. We have not disappointed on that. So I think obviously there is a lot of credit which goes to the government for managing and maintaining that discipline. As far as RBI's decision on the rates is concerned, it is obviously more complicated than just the fiscal deficit and inflationary trends. They also have to contend with what's happening in the global markets on the dollar strength. So there is very little breathing space available for the RBI on that front. If they get a breathing space on the forex front, then obviously all the kind of decks are cleared for a rate cut. So it's not something which obviously I can predict, but there are a couple of things which are going in favor of rate cut. We need a couple of things more, but ultimately it's a decision we will know very soon as to what happens on the rate cut.
Absolutely, sir. So getting to the consumer side of the story, which everybody is talking about right now, the tax ESOPs is one side of it, which is going to support the urban middle class, and then there's the agricultural schemes and everything, which supports the rural demand side. Which of these two you think is more significant is one, and the second part of the question is where do you see this excess discretionary money coming into the hands of the public going into?
Yeah, so tax cuts is mainly an urban support for urban consumption. But that is what is needed because urban consumption has been drifting down. If you look at the commentary of various consumer companies and consumer discretionary companies, so it needed a little bit of support. And our sense is that most of that income kind of relief or income tax relief will go towards discretionary demand, not towards staples, but more towards discretionary demand like autos, consumer durables, and maybe other discretionary spending like QSR, etc. So clearly there is going to be some support which comes from on the urban consumption side. As far as rural is concerned, I think we have been having decent monsoons. I think rural economy got hit post-COVID for a variety of reasons. I think inflation also hit them hard. And now it is gradually coming out of that slowdown, which was more structural in nature. So unless there is any bad news on the monsoon front, I think rural demand will keep on recovering gradually, in our view. And therefore, if urban consumption lifts up, if rural consumption continues in its recovery path, and if capex obviously continues, and next year could be even better with the government coming back in full force, I think we will be set for a 7% GDP growth rate. And I think that is the key because today the markets were factoring in a 7.5% GDP growth rate, and therefore at 5.4% GDP growth rate print, I think that will obviously a disappointment. So clearly, I think markets wanted to see also what the government and RBI collectively can do to pick up that demand. So while capex continues, the consumption support, the support to the consumption was a very important kind of step in that respect because consumption is 55-60% of the GDP. And therefore, if that slows down, even if capex is going great guns, it's very difficult to go beyond 6% GDP growth rate. So to that extent, it's a very, very timely, I would say, intervention. We need to see what role RBI plays. They've already done the liquidity kind of easing measures. We need to see what else they can do in the credit policy, either on the liquidity side or the rate cut side to continue to support that kind of growth push, which seems to be happening now.
Right, sir. So which sectors do you see benefiting from this move on the
I think
consumption side?
Yeah, on the consumption side, as I mentioned, I think consumer discretionary. So, what happens is that because consumption was slowing down, and mind you, not all parts of consumption were slowing down. There was a K-shaped recovery. I think autos did well last year, hotels did well, luxury, travel did well. So it's not that consumption was slowing down overall. There were pockets of consumption which were still doing well. But I think what will happen is that the the consumption basket will get more broad-based. And even from a economy or the sector point of view, I think today I can say that there are no sectors which we can ignore in the market. And it's a very good problem to have because banking is cheap and is turning around. Earnings growth is going to turn around. So that is looking decent. Pharma is doing well for variety of reasons, including generic market doing well and Indian companies changing their business model. IT is recovering after a bad year. We can see there are signs, there are green shoots of earnings growth coming back, not coming back to the extent we saw in during COVID, but at least recovering from its lows. We are seeing capital goods. The stocks have corrected. The fundamentals are not as bad as some of the stock corrections suggest. You have other sectors like power where I think fundamentals remain intact. And therefore, when I look across, and now consumption is getting lifted. So when I look across all the sectors, the big sectors, I see that one cannot be ignoring any sector or playing favorites anymore. What we need to therefore focus on is a diversified portfolio, have a sector neutral kind of a flexi cap or a multi cap kind of a portfolio. But within the sector, I think the stock movements or the stock specific nature of the movements will become more important. And therefore, what is going to play a very important role is to stick to the core categories like the diversified categories and not really be focused on picking the right sector or sectoral themes. If at all one has to play sectors or look at sectors, or my favorite or our favorite sector at this point of time, it will be banking and pharma. But as I mentioned, even within banking and pharma, there would be stock specific kind of movements. And for the rest of the sectors, I think it is going to be mainly bottom up stock picking.
Right, sir. Sir, for a while now, for the past few months or even about a year or so, capex sectors were a favorite of the investors, retail investors, at least. Let's say defense, the manufacturing, the capital goods. And like you rightly said, the fundamentals remain intact, and but the market has also seen certain amount of correction, so they are also available at relatively more saner valuations now. The other side is there's a new theme emerging right now, which is the consumption, which we also discussed. Now, you mentioned diversification, of course, is the need of the day. Do you think some rebalance may also be needed? So people have two choices right now. One is average down on whatever they have bought in the capex side of it. The second is buy into this new consumption theme. Which options do you say would be better for retail investors?
So I think the second option would be better. I think the days of thematics like power, defense, resources, manufacturing, those days are over. We need to recognize that because the valuations are still rich despite the correction. I think still rich in some of these segments. And more importantly, there are different companies, different fundamentals, different earning expectations, and therefore there are disappointments also which are happening today in these themes. So clearly, when that happens, you cannot blindly buy any of these themes and say that, okay, let me double down on or average down on any of these themes. I don't think that will be a right thing to do. The only two sectors, and I again repeat, the only two sectors which can deserve additional allocation is banking and pharma. Apart from that, investors should be focused on the core categories, and most importantly, in that being large cap, large and mid cap, and flexi cap. These are the most important categories because today I think the markets are going to be not as high beta or as high on momentum over the next 12, 18 months. And therefore, what will matter is the asset allocation within equities, and where large caps are looking more attractive than mid and small caps. And I think the budget does not do anything to get more excited on mid and small cap versus large cap. So to that extent, I think the second option would be much better in terms of looking at their asset allocation, figuring out whether the investors have much more thematic than what is required, figuring out whether they have much more small cap or mid cap than what is ideal in this circumstances, and then accordingly adjusting their fresh investments or their existing investments.
Right, right, sir. So there were a lot of other schemes announced as well, sector-specific schemes. For instance, we had lithium-ion export duties being reduced for EV sector. We had metal recycling for some schemes were there. We had nuclear energy-related schemes. We had for tourism, we had the Udan scheme, Heal in India. Any of these sector-specific themes you feel are significant enough for retailers to watch out for that may play out bigger than expected?
Not really. I mean, I would not, and I don't want to comment on such minute kind of specific announcements, because then there are specific stocks which come into picture. Obviously, there will be some stocks which will benefit, but to say that these movements are extra supportive for a particular segment versus other segment, I won't think so. I think the budget was fairly balanced, and therefore it is not right to really look at uh, look at it from a single stock perspective or a single niche segment perspective, in my view.
Right, absolutely, sir. So moving beyond the budget as well, for the coming decade, do you see any new themes playing out in India?
Well, I think healthcare is a big theme. We have been very bullish on it because as a country, we will move from in the next 10 years from being a demographic dividend heavy country towards a country which will require more and more healthcare, and which is basically hospitals and diagnostic labs and anything associated with. I think it's a highly underpenetrated sector in India. There is a lot of growth just by penetration, and obviously through better quality of service in tier 2, tier 3 towns. So from a decade perspective, that's one segment which is clearly looking, which is something different and something interesting to look at from what 10-year perspective. Apart from that, the standard consumption, I think, has slowed down last 2 3 years. It's been mixed, but I think it is coming back. And there are a lot of good things which have happened in consumption, and the companies have learned from their mistakes, whether it's a consumer discretionary company or a staples company, and they are changing their business models. So you would see that part of from a decade perspective that looks extremely interesting. As far as the other sectors are concerned, like infrastructure, etc., I think next 3 to 5 years look very good. But there are always cycles in infrastructure, so it's difficult to take a very very long term call. I think the next 2 3 years look really good, without doubt. But anything beyond that, we have to be a little careful in terms of predicting, continuation of that, because there are cycles in the economy. What I'm talking about, healthcare and consumer, will ride through those cycles, but other sectors like infrastructure or capital goods may not be able to ride through that cycle. Maybe one out of two or two out of 10 companies will be able to ride through that cycle, but not all 10 will ride through that cycle.
Right, right. So before we conclude, any advice for our viewers out there? It can be related to this key takeaway from this budget or anything that they must always remember.
The only thing is, I would say not to chase performance, because I have seen some tendency for people to buy into the thematic funds last year basis the last 12 months or last 2 years performance. I think that's the most obvious mistake one can avoid. And the second one I've already touched upon is to pay attention to asset allocation. Maybe, see, it's good that we all talk about investing for 10 years and all that, but every 3 years we should have a serious relook at our portfolios, because every 3 years things will change. Sometimes there will come a time when you will feel and you should also reallocate from either large cap to small cap or small cap to large cap or any combination. I'm not commenting on that specifically, but I think within that long-term view which everyone has, please look at portfolios on every 3 years at least. And if you see the need, there's no harm in tweaking your asset allocation so that your next 3 years you have lesser risk, a better risk-adjusted kind of return.
Absolutely, absolutely, sir. Well, that was a time. Thank you so much for taking out time for us, sir, and I hope you'll allow us more such sessions in future to learn from you.
Thank you very much. Thank you for offering me this opportunity. Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.